The following is a production of Professor Robert Barnwell. Each episode includes insights provided by the chairman, CEOs, and CFOs of the world's most successful corporations, as well as thought leaders from premier business schools and international consultancies. If you and your team would like more information on corporate leadership and strategic management, or would like to learn more about Professor Barnwell, his research, and how he may be able to assist your company, please visit Professor Barnwell's website at robertgbarnwell.com.
Hello and welcome to CFO Talk Radio. I'm your host, Robert Barnwell. During the last episode, we spoke with Jeremy Hope, author of Reinventing the CFO, who shared with us some of the long-term forces that are driving a change in the view and role of the CFO and senior financial team, as well as some of the key findings and suggestions contained within his book. This is episode 4, and today we'll be speaking with Bill Spizman. Bill is a managing director with RSM McGladrey's Transaction Support Services, and he's agreed to join us to talk about the due diligence demands of international merger and acquisition transactions. So, Bill, welcome to CFO Talk Radio.
Thank you, Robert. I look forward to participating today.
Well, we're really glad to have you, particularly since I realize you're a specialist in M&A due diligence, and we've just seen a huge increase in international mergers and acquisition activity over the past 5 or 10 years. Can you walk us through some of the economic and market drivers that are really fueling this increased activity, and not just simply for maybe financial or private equity buyers, but also strategic and corporate buyers?
Yes, Robert. There has been an increased merger and acquisition activity. The primary drivers attributable to the increased activity are, one, as everyone knows, globalization of the world economies. Globalization has increased competition, forcing companies to find ways to reduce costs and to enter markets outside of their home turf. Also, customers requiring their suppliers to follow them into these countries. For example, if you're supplying an international business and they're expanding into a new country, they may expect you to follow them. And then, of course, lower costs to manufacture and operate certain aspects of the business. For example, if you're a manufacturer using contract manufacturers overseas, or if you're a service organization using call centers located outside of the United States. Also, it provides companies an opportunity to grow since the domestic market is not growing fast enough. We recently assisted a portfolio company of a private equity firm consider the acquisition of a Brazilian distributor. So it was a way, one, to kind of control what was going on in Brazil, but also additional revenues and profits that could be generated from that business. And also, the U.S. dollar being stronger and the cost of capital being lower, overseas investments are very attractive. And of course, competition, you don't want your competitor to operate in a country before you. Okay.
I would also assume, to kind of pull on this thread, the competition for deals, up until maybe the credit crisis has been just so high in North America and Europe, and the valuations just really, really spiked. I mean, is some of this international activity being driven by the fact that it's just really difficult to find a good transaction in terms of a valuation standpoint?
That was clearly true before the recession. And then in the recession, what we've seen is slow or reduced growth or negative growth, and to be able to grow, companies have seen their foreign competitors struggle as well, which are providing opportunities for them to either merge with these companies or buy these companies at lower prices, and then to benefit from whether there are synergies or abilities to increase price without the competition. Those types of opportunities are very attractive to buyers.
Okay, so they can actually source proprietary deals and not have to worry about everything going to auction the way that they have been, I guess, here and in Europe, I take it.
What's kind of interesting when you talk to investment bankers, they say their biggest competitor is not another investment banker. It's a deal being sourced without an investment banker.
A few years ago, I read an alarming statistic. True or not, it was nevertheless alarming. I want to attribute it to Business Week. And it was basically saying that, and my assumption is it was purely a domestic U.S. statistic, that somewhere north of 2/3 of all acquisitions in hindsight didn't make, the return didn't justify the expense. And I'm going to assume that as difficult as that is in the U.S., and whether the statistic is 2/3 or 1/3, it doesn't matter. It's an alarming number, and I think really underscores the importance of what you and your team do in terms of due diligence. I'm wondering, from an international standpoint, the demand and expectations on due diligence have to be all that much higher. So, what do international transaction, what do they introduce, the concerns and challenges that maybe a domestic transaction may not?
That's an interesting statistic. I generally hear more than half. So when you say 2 to 3 of the mergers and acquisitions are disappointing, it happens a lot, and some of it becomes known when you see companies that are troubled after an acquisition, but others you really don't see, but the investors or corporate partners are really investing additional monies more than what they might have expected to invest. But understanding the reasons why, clearly one, I think, is not thoroughly evaluating findings identified in due diligence or fully understanding the impact of the findings on future earnings. Another example would be underestimating the costs or efforts required post-closing in the merger and integration activities. Another is overly optimistic forecasts, whether it's top-line growth or cost synergies, leading buyers to pay too much for the acquisitions, which, as you know, are great for sellers and bad for the buyers. Mm-hmm. Clearly, another one is difficulty of oversight. If you're acquiring a company in Europe, the ability to get there, to deal with the issues, and to get back home, I think it is very difficult for oversight. And then also just aligning management's incentives with those of the buyers. There's clearly cultural differences, and I believe that those are frequently underestimated as well as any business differences in the countries.
Okay. So, in addition to culture, for we've got a senior, corporate professional, maybe they're used to doing, a handful of M&A transactions over their career over the past, say, 5-10 years. And now they start looking at transaction in, say, China or Brazil after having done primarily U.S.-based transactions. In addition to culture, are there any other things that they really need to be conscious and concerned about when looking at international M&A versus domestic?
Yes. Clearly, there are differences in legal, tax, and business practices in the foreign countries. So it's critical to have experienced professionals knowledgeable about those matters. And maybe to illustrate a difference in the area of financial and tax due diligence for a company operating in Brazil, let me provide you with an interesting fact. A Brazilian company, before they can issue an invoice to a customer, they must report the activity in the form of an electronic invoice to the state government prior to shipment and receive government approval and a government-assigned invoice number. So what's nice is that you can kind of rely on what the recorded revenue is to a great extent, and that the VAT taxes that are being paid are clearly correct. So, your financial exposure from the area of underreported activities is not there in Brazil. However, there are other exposures that you need to be aware of, and one would be in Brazilian labor law, for example. it's very costly to employ workers. The social costs of employing a worker are much higher than the payroll costs that we're familiar with in the United States. So what the Brazilian companies try to do is, instead of employing a worker, what they try to do is to employ an individual as an independent contractor. Well, you don't want to be the buyer of that company if those independent contractors really should be treated as employees. And what's interesting in Brazil is that the employee can walk into court, or in this case, the independent contractor could walk into court and provide evidence that he was really an employee, and the company would have a significant tax exposure from that, which is a little different than the rules and regulations in the U.S., both on, processing an invoice as well as paying people.
Yeah, it certainly could serve as a shock to a lot of people who may not know that. And again, that's just one example. Well, let's take a closer look at the due diligence team itself from the corporate perspective. Do you have any recommendations on how a client should staff up internally for maybe a one-off international transaction versus an ongoing international M&A expansion effort with, maybe multiple transactions? Is there a mix in terms of what you think should be brought in-house versus what you'd suggest is best farmed out to an experienced consultancy and team such as yours?
Yes. My recommendation, if you're staffing a one-off M&A due diligence transaction assignment, it would be for the buyer to engage professionals who have experience and international experience and representation in both countries. It's critical for the buyer's representatives to work closely with the transaction professionals to leverage their understanding of the industry and business with their advisor's M&A experience and knowledge of the local business practices and regulations. So if you're, doing a one-off, do it as a team. And then if you're, doing a lot of transactions internationally, what I would suggest is that you kind of have an internal project leader that manages the outside consultants and advisors. And in that way, you've got the expertise and resources to handle multiple transactions, as well as the benefits and understanding of the local business and regulatory reasons and statutes.
Okay, well, that's a wonderful suggestion. I mean, in terms of this project leader, if you were going to craft the ideal project leader, what type of background and skills should this particular person have, in your opinion?
The individual should have a very good understanding of the business and the industry, as well as an internal knowledge of the buyer and the buyer's company and who to put in place and who to introduce in various situations. One of the interesting things when you're doing an international transaction is that the target's management, they want to feel very, very comfortable with the buyer and the buyer's management. It's very, very important to get a high confidence and comfort level initially, and that internal project leader can be the liaison between the buyer and the target's management.
Well, that sounds like terrific advice. And before we let you go, I'm assuming that you've been involved in dozens, if not hundreds, of transactions. And I think it'd be nice, before we let you go, if you might be able to compare and contrast those clients that you feel have been particularly good versus some that may have seen their efforts crash and burn over the years. Certainly, I'm not asking you to name any names, but it'd be nice if we kind of saw some common comparisons and contrasts in terms of approach.
One of the questions, Robert, that I ask when I'm meeting with a corporate buyer or principal of a private equity firm, and I'll generally always ask the question, have you ever walked away from a deal? Because it's really difficult to walk away from a deal when you've got lots of time and money invested in the transaction, you like the product and management, and you see significant opportunities to grow your business, and you're emotionally involved, but you got to walk away because it's probably the right thing to do. It's hard to break yourself away, but to maybe use a sports analogy, some of the best trades that are the ones that never occur, well, the most successful investors are the ones that are the most disciplined and aren't afraid to walk away from a transaction. You can invest in the next opportunity, and the time and money invested in the due diligence did just what it was intended to do, to protect your capital and to keep you from making a poor investment. I think that's really the key here is that you've got to have the ability to be objective with respect to the investment opportunity, because you've got alternative investment opportunities. And really what you've lost is, the time and money that you've invested to date. But if you make a poor decision and you go forward, dealing with the company post-acquisition could require more capital and could require a substantial more amount of time and efforts and headaches that you could have not had you walked away.
Well, I think that is fantastic advice, Bill, and I really appreciate your insights into the international M&A market and due diligence, and hope that we can have you, or members of your team on again sometime in the future.
That would be great, Robert. I enjoyed the discussion and look forward to it again.
All right. Thank you so much. That was RSM McGladrey's Bill Spizman talking with us about the due diligence demands of international merger and acquisition transactions. Please join us for our next episode when we're joined by Wharton School of Business professor Larry Rabiniak. Professor Rabiniak is the author of Making Strategy Work and oversees Wharton's highly regarded Implementing Strategy, Leading Effective Execution program. During a recent visit to our companion show, CEO Talk Radio, Larry agreed to speak with us here on CFO Talk Radio about strategy execution and the role of the CFO and the CFO's senior finance team. Until then, this is Robert Barnwell and CFO Talk Radio wishing you all the best.
We hope that you have enjoyed this episode and found the material of value. To download a transcript of this episode, receive a free subscription to the show, or to learn more about this subject, we encourage you to visit Professor Barnwell's website at robertgbarnwell.com to explore the many executive briefings, presentations, case studies, and other resources available for immediate download. This has been a production of Robert G. Barnwell. All rights reserved.